Welcome to Tuesday's Commodities Corner. I'm Elaine Stenson. The commodities market saw a choppy 2013 with soft commodities, coffee in particular, lacking lustre. But last month some prices did rise. Shawn Hackett, president of Hackett Financial Advisors in Florida, joins me on the line now. Shawn, can this price rise be attributed to the seasonal demand pattern, or do you think the reason for the price rise was a supply shortage?
Well, there is a supply shortage. The market didn't go down because there was an oversupply. The market went down because of forced liquidation in the futures market. And remember, the futures market is money. And people are on one side of the trade or the other. And sometimes when people get caught on the wrong side of the trade and are forced to liquidate, you can get a market going down having nothing to do with the true supply and demand, just having to do with someone having a money problem that needs to get out to cover margin calls. So we had one of those situations in coffee where we just dramatically overshot. And then when the Vietnam harvest started getting underway, everyone fully realized that the crop was nowhere near as good as everyone thought. Certified stocks in London are basically drawn down to zero. Premiums to cash in Vietnam were above futures. And then, of course, this past week, we've seen this dramatic reduction in the Brazilian crop potential by analysts, and everyone's reducing their expectations for the crop coming next summer in Brazil by as much as 20%, which is something I predicted 2 months ago would have to be the case. So what's starting to happen is now we're starting to see that people are talking about significant deficits in the upcoming year and realizing that we never really had that much coffee to begin with. And so all of this is starting to bring the market into realization that coffee prices trading well below the cost of production are unsustainable, and they better get the market up quickly so that the supply crunch that's coming can be minimized as much as possible. You
mentioned Brazil there, Shawn. Consumption in the BRIC nations is expected to rise moderately. What effect will the weak Brazilian real have on this?
The weak Brazilian real only means that farmers in Brazil are getting a higher price today than they would have gotten if Brazilian real was stronger, like it was a few years back. But understand, even with the weak real, they're still losing money selling coffee. So, it doesn't really matter, right? I mean, if you're losing money, if you're losing $2 on a pound of coffee versus $1, it's still not a very good trade. So a weak real will bring some extra selling out of the market, but when it's being done at a loss, it has a minimal effect.
Do you think investors who still are long on coffee should be cautious?
No one's long on coffee. We've had a record short position in coffee for over a year, so there's nobody investing in coffee, and everyone's still heavily short. So the shorts, the real question is, should the shorts still remain this short in coffee? And the answer is they better get out before they lose too much more money. No one's gone long coffee yet, so this is a great time to be buying.
Shawn, thank you for that, and thank you for joining me on the line today. And that's all for today's Commodities Corner, but Thomas Tappin will be back with more on Thursday. Bye for now.